Hey guys, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency Batch. Okay, so what we have been doing, sir, we have been doing the various theories for money demand, right? Money, as we discussed, one of the most important factors in our life, and how and why we are demanding the money. So we have been doing the various theories. We were just left with two theories. One is the Friedman's theory and another one is the demand for money as a behavior towards risk given by Tobin. Okay, let's see. Let's quickly finish it off, and with this, the chapter is going to be over. So let's see what the Friedman has to say about this particular theory, which we call it as Friedman's theory. The Friedman 1956 extended the Keynes speculative money demand within the framework of the asset price theory. Right. So what is this asset price theory? He says the demand for money is similar to the demand for a capital asset. Right. Let's say you want to buy a plant and machinery. Okay, let's try to understand this thing. Let's say you have a capital asset. What is a capital asset? We have already discussed in financial management in the chapter of capital budgeting, right? So that concept we are going to use here, right? So capital asset, when you are going to buy the capital asset, what are the various factors that you keep in mind? He says the money is equivalent to a capital asset. Now, when you buy the capital asset, we have already studied in the chapter of capital budgeting that at the time of buying the capital asset, what do you see? You see the present value, of cash, future cash flows, right? What we calculate is the present value of the future cash flows and then decide that whether we need that, whether we should be buying that asset or not. Similarly, he says when you are demanding the money, right? When you have demand of money, that means how much of the money you should be having in cash, how much of the money you should be investing in the securities, the interest bearing securities. He says that is dependent upon the present value, two factors: present value of what? Future income. Sir, if you want to buy Mercedes, right, it is dependent upon what? That what will be your future income, whether you will have the sufficient income in the future to pay off the EMIs of the car or not, right? So what we are trying to find, because when you want to buy Mercedes, you will have the demand for money to buy that Mercedes, right? And that will be dependent upon whether in the future also you will have sufficient money to pay off the EMIs of the car or not, right? The present value of the future income, right? So it is future income. If you, how you calculate the present value? So present value is calculated by future income divided by discount rate, right? Discount rate, as we all have studied in the chapter of capital budgeting. If not yet, please cover from there first, right? So that is what he's saying, that according to him, the demand for money is similar to demand for capital asset. According to this theory, the demand for money is affected by permanent income. Permanent income is the present value of all the future income. Present value, expected value of all the future income, and the relative return on asset, that if we are going to invest in some asset, then what is going to be the return on that asset. Okay. Okay, it says the determinants of the demand for money are the permanent income. The nominal demand for money is a function of total wealth, that is the permanent income. It includes the average return on 5 assets. That means what he's trying to say, he says this discount rate is what? This is what is known as return rate, right? That what is the return on that money that we are expecting in the future. So he says this is a combination of 5 assets, right? This is a combination of 5 assets with money, bonds, equity, physical capital, and the human capital, right? Land, labor, right? And all those things, on those combined on those, what is going to be the return? That is going to be used as the discount rate to calculate the present value of the future income. Money, bonds, equity, physical capital, and the human capital, right? Physical capital is land, plant and machinery, right, which you are using. Human capital is, all you know, we are the human capital, right? What is the return on these things, right? That is to be considered as discounting rate. Then is the price level. The demand for money is positively related to the price level. This we have already studied, that if the prices are more, the demand for money will be more and vice versa, right? Opportunity cost. The demand for money is inversely related to the opportunity cost. If the opportunity cost is high, the demand for money will be less, right? If the return on the bonds and stock declines, the nominal demand for money rises and vice versa. Sir, please explain how it is inversely related. Try to understand that we say with the opportunity cost, it is inversely related. Try to understand. You have a cash of 10,000 rupees, right? You have in the form of cash 10,000 rupees. Now the bank say there are two situations. One situation is where if you deposit this money in the bank interest that the bank is going to pay, that is at the rate of 1% only, right? So this 1% interest rate, that 1% interest rate, that is rupees 100, is your what? Is your opportunity cost, right? Now, another situation where the bank says this bank interest will be at the rate of 10%, right? Now, what is the amount that you will be getting? Sir, 1,000 rupees, right? This is what now? Opportunity cost. So how they are inversely related? Sir, at this particular level, when the opportunity cost is 100, that is less, your holding for money, your demand to hold the money as cash will be more. Demand to hold money as cash, to hold money as cash will be high, right? And here, when the opportunity cost has increased, now what will you do? You will say it's better to deposit the money in the bank, right? Why to lose this 1,000 rupees? So when the opportunity cost has increased, your demand for nominal money has decreased. Demand for money decreases. Clear? So this is how they are inversely related, the opportunity cost and the money. Then is the last is the inflation. The nominal demand of money is influenced by the inflation. A positive inflation rate reduces the real value of money, thereby increasing the opportunity cost of money holding. Now, if there is inflation, there will be high prices. High prices means you will need more money. Why? Because what is the meaning of reduces the real value of money? Let's say at a particular point of time, let's say on 1/4, you have a cash of 1,000 rupees, right? Now with this 1,000 rupees, you are able to buy 1,000 chocolates, right? That is 1 rupee a chocolate, rupee 1 per chocolate. Now on 30th of September, let's say, due to inflation, what happens, sir? The rate of chocolate, which was 1 rupee, it has increased to 5 rupees per chocolate. Now, can you buy 1,000 chocolates with this 1,000 rupees? No, sir. Now, if you want to buy 1,000 chocolates, you will need to have more money, right? So, your demand will increase, right? So, here, if you want to buy 1,000 chocolates, your demand for money will increase, right? Your demand for money will increase. Clear? So this is what is the relation between the inflation and money. I hope this is clear. So this was the Friedman's theory, a very simple theory, and it was an extended of the Keynes theory. Speculative money. Why speculative money? Because that is what we are saying, because it is dependent upon the opportunity cost, right? Opportunity cost means whether to hold money as cash or to hold money as bonds or the other interest bearing securities, right? Okay. So let's move on to our last theory, that is the demand for money as a behavior towards the risk. Right. So he says the demand for money depends upon the behavior of an individual, that whether that individual is ready to take the risk or not. Right. If that individual is has the capability of risk taking, then he will hold less of money in cash and he will invest more in the market, in the bonds and all those things. Right. Just try to understand one thing here. We say that we can hold money as cash or as bonds, right? In the bonds, we are covering any interest bearing security of the market. Now, there are two factors which are involved here. If we hold the money as cash, will there be any return on this money? Right? Return will be nil. And there is one more factor, that is risk involved. Risk involved is very low, sir. Right? The only way you can lose money is that you forget money somewhere, isn't it? That it is lost. But in case of bonds, your return is high, no doubt about it. Your return is high, and at the same time, here your risk is high. Your risk is also high, sir. Right? So if you are a risk-taking person, right, then what will you do? You will invest in the bonds, risk-taking. Right? So your demand for holding the money as a cash will be less. But if you are a risk-averse person, in that situation, what will happen is your demand for money, your demand for holding the money as a cash will be high. Right? So that is why he's saying that the demand for money is dependent upon the behavior of an individual towards the risk, whether he is ready to take risk or whether he is not ready to take the risk. So Tobin presented the theory of risk-averse individuals' behavior. The theory suggests that the negative relationship between demand for money and the interest rate. Interest rate means this one. Interest rate means the return on these bonds. Right? So if the interest rate is high, right, that means this return is very high, then your demand for money as to be held as cash will be low. Right? If the interest rate is high, your demand for money will be low. That is why I'm saying the negative relationship, or what we call it as inverse relationship. Right? An individual's optimal portfolio structure is determined by the risk or the reward characteristics of the different assets, and the taste of the individual in maximizing his utility consisting with the existing opportunities, that how the individual looks at the various returns along with the risk that is associated with the particular asset, right? An individual would hold a portion of his wealth in the form of money in the portfolio because the rate of return on holding the money was more certain than the rate of return on holding the interest earning asset. Sir, even if the return is nil or low, but at least that is certain that money is with me and I can buy anything in the future. That is the return on this particular money. It entails no capital gain or loss. That is obvious, sir. The value of the money is going to remain same when it is lying in your pocket. The bonds and equities are subject to the market price volatility while the money is not. That is why we say the risk is high. Why the risk is high? Because the prices of the bonds and any interest bearing securities in which if we are investing the money, that can fluctuate with the prices in the market. Right? The prices of these bonds and the securities are dependent upon what are the prices prevailing in the market. So accordingly, you can have a gain, accordingly you can have a loss also. Right? Huge losses you can have. So according to Tobin, the risk-averse individual prefer to hold the optimal wealth portfolio which consists of both bonds and the money, but he will prefer more of money in the portfolio. Although the overall return would be higher if the portfolio consists of only bonds, right? So if the portfolio is only bonds, return will be higher. Obviously, that is what we are saying. The bonds give you higher return, but they contain the higher risk also. The risk-averse investor is ready to sacrifice some extent of higher return for lowering the risk. So theory asserts that the demand for money as a storage of wealth varies inversely with the interest rate, right? As a store of wealth means that you want to hold money as a cash for the future contingencies, for the future expenses. So if the interest rate is high, that storage of value of the money will be less, right? You will be holding less of money for this particular purpose because you don't want to, if you are ready to take the risk, right? But if you are not ready to take the risk, then you are ready to sacrifice some of the interest that you might, earn from the bonds, and you say it's better to keep some money as a safety. Clear? So this is about the money demand. We are done with the whole chapter of money demand. These theories of money demand are very, very, very important, and specifically this particular theory, liquidity preference theory, is one of the most important, where you are getting 3 motives and any of the motive can be asked in the examination individually also. Right? So these theories are very, very important. This Cambridge approach can be asked individually, that what is Cambridge approach and all those things. These can be asked individually, and this is the way you can absolutely write in the examination. right? So we are done with this money demand. The next chapter that we'll be starting is the money supply. Now we say that we have demanded the money, and will there be enough supply for that money also? Let's check it out in the next lecture, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.